Welcome to lesson 4, episode 4, I guess you could call it, of Company Valuation 101. And this is actually part 1 of a 2-part series I'm going to do on 10K reports, because I found that a lot of people don't actually use them in their research process, and I'll be discussing the value of them here and exactly what you should be looking for. So we already know valuing a business is part art and part science. Thanks, Warren. But here I want to discuss the onion model. And this is something we'll be going into depth more on in our second book, which is called Bear Market Investing Strategies. And the reason we included it in the second book is because the guy who kind of popularized the onion model is a guy called Jim Chanos, and he's known as the Warren Buffett of short selling. And Chanos's hypothesis, which he calls the onion, is that there are 5 layers of analyzing a business. And most investors, when they look at investing in a business, at least retail investors, but this happens in institutions as well, is they go from the outside in. In other words, they start at layer 5 and they work their way towards layer 1, but usually they've made their decision far before they get to layer 1. And the best investors go from layer 1, which I'll be explaining what that is in a moment, to layer 5. They go from the inside out. Because the inside is the least comfortable information, but it's the most accurate. Whereas the outside is the most comfortable information, but the least accurate. So here's the onion model in a basic diagram. So layer 1 is the 10K filings, and these are the legally mandated filings that any public company has to submit to the SEC once a year. And there are so many restrictions about what you can and can't say in these filings, and they have to be independently audited. So this is where you will find the least amount of spin on the prospects for company, because this is where you'll get all the financial data, and this is where you'll get the outlook for the company's prospects. Layer 2 is then the press releases. We'll also include quarterly reports in that. And the reason quarterly reports aren't in layer 1 is that quarterly reports don't have to be audited, whereas the 10K annual report does have to be audited. Layer 3 is earnings calls with analysts, because a lot of these earnings calls, it's management giving a positive spin on things and then answering a few softball questions from a select group of analysts who they already know are going to give them good ratings. Layer 4 is then analyst reports, because analysts have their own agenda when it comes to reports on companies. In our book, Bear Market Investing Strategies, we use the example of, I believe it was, there was 2 analysts. It was UBC Warburg and someone else. The name escapes me, the second one. And they had Enron listed as a buy rating, even after it had lost 95% of its value. So that just goes to show that analyst reports, take them with a pinch of salt. And then layer 5, and this is honestly, unfortunately, where most people start and stop. And that's just mainstream news reports, social media chatter, and then tips from family and friends. And as I said in the previous slide, this is the most comfortable information because it doesn't really challenge your views. So to give you a timely example of this, airline stocks are very popular right now, because they were, due to the coronavirus and subsequent pandemic, pretty much every single airline lost a big chunk of its value. And therefore, a lot of retail investors were immediately very bullish on airlines, because they were thinking, it has to come back. This will only be temporary. I'm getting a bargain here. And so they went on, they watch the news and they see, they go on CNBC, for example, and they say, oh, airlines are a bargain. They're a great buy right now. Be greedy when others are fearful. Or they go on social media and they go to an investing group on Facebook and they say, oh, I'm thinking of buying American Airlines right now. And, people will say, yeah, that's a great idea. It's really cheap. This is only temporary. It's going to go back easy 100% within the next 18 months. Stuff like that. So it just sort of reconfirms your existing hypothesis. Whereas if you went to layer 1, which is the 10K filing, you would see a very, very different reaction. Some of these airlines have massive debt levels. Some of them have had to lay off huge numbers of staff. Many of them say that they're only going to be operating at half capacity for the indefinite future. This is the real accurate information here. Yes, it's very uncomfortable, and yes, it might change your mind. But the fact is, if you start there, and if you start at the information that is not comfortable for you, then you will escape a lot of bad investments, because you will see very early on that your hypothesis about a company is completely wrong. Or you will find out that this company isn't what you thought it was. This company has problems that you didn't even know about. And that's where the value of the 10K really comes in. So it's uncomfortable reading, but it's 100% necessary. Now, yes, it is the most boring, but it is the most accurate report. And I just want to make a very clear distinction here. It is not the annual letter to shareholders. The annual letter to shareholders is like level 3 or 4 information, because it's got a lot of spin in, everything has to be good news, and it's not audited or anything like that. The 10K is the annual filing to the SEC. So there's only one per year. The 10Q, the quarterly report, is not audited. So the 10K is legally mandated by the SEC. It is independently audited. Inaccuracies must be corrected, and all risks must be included. That's very important. So what are the things we look for in a 10K report? So there are a few sections that are very useful. One is the intangible section, particularly patents that a company might hold. A company will list all its patents inside the 10K report. Just to note, though, patents are pretty much useless if there's no products to use them on. It will talk about the company's competition. Companies have to list prospective competitors within their 10K report. It will list any lawsuits the company is currently involved in. That's both active lawsuits and ones that are pending. And it will also outline the true economics of their business model. And that is very useful, especially if you're looking at growth companies, companies which are not yet profitable. And that will really outline where this potential profitability is going to come from. Because it's not just the case of, for example, a software company, the more users we get, the more money we'll make. Because let's use a company like Zoom, for example, very popular right now. Zoom have actually done a pretty good job of converting free users to paid users, because a free user costs them money. They take up server space, they have to pay for all that bandwidth. They don't make Zoom any money. It's the paid users that make Zoom money. And so within the 10K report, you will find out, okay, what percentage of their user base are actually paid users, or how many paid users do they need to achieve profitability? These are the real numbers, not the fluff numbers that you'll find in the shareholder letter of, we have 100 million active users. Like, that doesn't tell us anything, because how many of those active users are actually paying customers? Another big section to note is the risks section, and this is probably the most important section outside of the financials. Because the risks section is where the company has to specify every single risk to the business model. And if you haven't read a 10K report before, you'll think every single company is doomed just by reading this section. But in a little bit, I'll show you how to really interpret this information and how to accurately view it. So every single company is going to have to list generic risks that every single business faces, such as forex risk, such as taxation risk, such as competitor risk, things like seasonality. This one, which I'll talk about in a little bit, and that I call that one the if all our customers disappear, we won't have a business. There's a specific risk for that, which is funny because obviously that applies to literally every business. So don't be too concerned. But then there's company specific risks, and these are ones you won't find on every single company's 10K report. So this will be things like heavy dependence on a single figure. I'll be showing you Tesla's 10K, and they say something very interesting in there. Things like dependence on just a few suppliers or clients. So say, for example, we're looking at a semiconductor manufacturer, and 80% of their revenue is from a contract they have with Apple. Now, if that contract ends and they don't get a replacement, or Apple decides to go with a new supplier, then their entire business is turned upside down. So it's important to know things like this in advance. You'll also find, especially speaking to COVID and the subsequent pandemic because of it, this is where you'll find that information within the 10K report. So now let me just show you what it is we're looking for. This is not the 10K. The very important distinction here. So if you search annual report in Google, you'll probably come up with, there'll be a couple of links in each company's website. So this is a publicly available report. So companies will host it on their website. Usually it will be in the investor relations section. So just search literally company name 10K in Google and you'll find it. This is the investor presentation. It is not the same thing. This is what we're looking for. It will say annual report. And as you can see in the file name here, it says 10K. And for this, we're using Fastly, which is it's a growth company. It's a edge cloud computing service. And so this is what we're looking at. So as you can see here, this will be on the front cover. So if you can see this, you can know you're in the right place. So this is for the fiscal year ending December 31st. So I believe this was put on their website in late February. So that's sort of the timeline you're looking at. And as you can see, it's a very big, dense report. It's 136 pages. Let me just show you how big Tesla's is. Tesla's is 418 pages. So they're pretty meaty. But you can, I'll show you which parts are important and which parts aren't. So they're dividing into different sections. A lot of it is company business, and they have to disclose, if there's changes in management, if there's changes in shareholder equity, if there's been large stock buys, things like that. Then there's the financial section. And then the real bit we're interested in here in this part is risk factors. So I'll just cover what exactly each part means. So business is them just describing how the business works. I won't talk too much about this because this is, specific to Fastly. And if you're interested in Fastly, I'd recommend going through this report yourself. And so they outline the business model, they outline what they do. They will outline their competition in this section as well. So here you see competition. And they talk about, okay, here are our competitors. So you might have heard of some of these companies. Cloudflare is another one, which is a public company. And they talk about, Amazon's CloudFront, AWS, Google Cloud Platform. So they'll talk about their competitors, which is important to know. They'll also talk about their intellectual property. So as you can see here, the company has 40 patents. And that includes the expiration date. Once again, patents are useless without products, but it's good to see if a company has patents for its technology. Legal proceedings, I don't see, we are not presently a party to any legal proceedings would adversely determined adversely to us. So they're not involved in any pending lawsuits. It's not a huge red flag if a company is involved in a lawsuit because it's quite common, especially where patents are involved. patent lawsuits happen all the time. And, even if companies are involved and even if they lose them, most of the time it's not massively detrimental to the business. But it's good to know if they are involved in one. So this is where you'll find it. It's in the business section under legal proceedings. So now we go on to risk factors, which is an important section. So here, obviously, if we're unable to attract new customers, our business will be harmed. This falls into generic risks that every business suffers, not a big red flag. But as you can see here, the language is very, very neutral. And it's actually quite negative language. And this is because the SEC makes them use this language because they have to be as accurate as possible. So don't be alarmed when you see language like this. It's not all doom and gloom. So, more things in the generic realm. Our business depends on customers increasing their use of the platform. Any loss of customers or decline in the use of our platform could harm our business. Yes, that's like Coca-Cola saying, our business depends on the consumption of our beverage, and any loss of consumption will harm our business. You see where this goes now. Now, let me just switch to the Word version of this because I've highlighted some risks that are company specific and will be very, very useful to your investment process. So here, for example, our limited operating history and our history of operating losses makes it difficult to evaluate our current business and prospects and may increase the risks associated with your investment. So what that means is the company doesn't make any money yet. And if your investment philosophy is only to invest in companies that make money, you can stop here because no information from layers 2, 3, 4, and 5 of the onion model is going to change your mind, because here is the factual statement. We don't make money yet. We have a history of operating losses. Therefore, it's a risky investment. So there you go. I'm not going to go through every single one of these because it is a lot of information, but I have highlighted a few which would be very useful to a prospective investor. We receive a substantial portion of our revenues from a limited number of customers, and the loss of or a significant reduction in usage by one or more of our major customers would result in lower revenues and could harm our business. Now that's very important. As you can see here, it says, I'll just highlight this for you. For trailing 12 months ended December 31st, 2019, our top 10 customers accounted for approximately 29% of our revenue. So almost a third of their revenue comes from the top 10 customers. Now, it's not a concern by itself, but it is something to be wary of because, as you know, previously they said in this report, there are a lot of competitors in this space. You have Cloudflare and then you have legacy providers. So, losing one or two of those top 10 customers would significantly impact their revenue and would harm their path to profit. So that's something to look at. Another one of these is, as you can see here, this is the COVID stuff. This is where you'll find it in the risks section. We've taken certain precautions due to the recent outbreak of coronavirus that could harm our business. For this particular company, and I'm not going to read all of this, but to be honest, coronavirus did not necessarily harm them. As you can see here, to this end, we're temporarily requiring all employees to work remotely. To be honest, most technology companies weren't that affected. A lot of their workforce was already remote, or even if they weren't remote, their functions could be carried out remotely, so there wasn't too much of a disruption. See if there's anything else here. Yeah, once again, something like this is a case of if no one uses our business, we'll go out of business. So this is not concerning. Of course, usage of the platform accounts for substantially all of your revenue. You're an edge cloud platform, same as the Coca-Cola example. If people stop drinking Coca-Cola, Coca-Cola goes out of business. That is not news, but they have to include this in the report, which is why this report is so useful. There is one other thing I wanted to point out. This stuff like this is important. Supplier relationships. So here it says we rely on third-party hosting services such as AWS and Google. Therefore, if they do not allow us to continue using their services because they also offer competing services to us, that will impact our business. So that's something to note. So, for example, if Amazon says to them one day, hey, we now view you as a direct competitor. As such, we won't allow you to use our hosting service. So that's something to be aware of. And it's a very company-specific risk. That's what you're looking for here. Is you're not looking for generic risks like Forex or taxation. You're looking for risks to this specific business in the 10K report. Speaking of which, let me just show you something in Tesla's 10K, which is very interesting. This line by itself here, if we are unable to attract or retain key employees and higher qualified personnel, our ability to compete could be harmed. Now that pretty much every company's 10K will include that, because obviously key personnel are key personnel for a reason. But here's where it gets interesting. In particular, we are highly dependent on the services of Elon Musk, our chief executive officer, and Jeffrey Straubel, our chief technology officer. None of our key employees is bound by an employment agreement for any specific term, and we may not be able to successfully attract and retain senior leadership necessary to grow our business. Which means, if Elon decides he doesn't want to do Tesla anymore, he just wants to focus on SpaceX, or he just wants to focus on whatever he wants to focus on, if he wants to run for president, for example, it's going to be a massive detriment to Tesla's business. So things like that, massively dependent on a single point of failure, in this case, a person, that's something to really watch out for. And, you wouldn't really find this out in other information. So that's something that's very company specific, and that's something that you really need to pay attention to with these reports. So I hope this lesson was useful, and in the next lesson we'll be discussing how to read the financials part of the 10K, which is the other very useful part of the 10K report and the most accurate financial information you will get about a company.